Hi there, my name's Chris Cann with Mining Journal, and I've got LSE listed Emmerson CEO Hayden Locke on the line. Emmerson's developing its Khemisset Potash Project in Morocco, and Hayden, I understand there's some pretty big news out this week in the form of a full feasibility study. Is that right?
That's right, Chris. Thanks for having me back. Always good to see you. And yeah, we've released our feasibility study, the long-awaited feasibility study.
Okay.
And yeah, we're very, very pleased with the results.
Okay, so how does it look from the previous studies that were out, the numbers that you guys published then? Has it improved? Have you had to pull things back in certain areas? Maybe starting with just the very the top level headlining kind of NPV IRR style numbers. How does it compare?
So we put out the scoping study in November of 2018, and relative to that is improved quite a lot, which we're very, very pleased with. So the top line headline capex for the potash project has actually come down, which is very, very rare for mining projects between scoping study and feasibility study. You know, that's a really pleasing result that we've been able to get that headline.
How has that happened?
Well, there's a variety of reasons, but one is a different contracting strategy. We've got a very favourable quote from a mining contractor, which just allows us to take out around $55 million worth of mining equipment from our upfront capex and then pay that off over the life of the mine. And economically, it made almost no difference to our economics, so it makes perfect sense for us to remove that from the overall. So very, very favourable. That obviously leads in the operating costs, about $170 a tonne, all in sustaining delivered costs to our target markets, really, really puts us in the bottom quartile. What the slight difference about this project is when we were doing the process design work, we realised that actually the process flow sheet that we have produces a de-icing quality salt as it is. So we have actually included the capacity to produce a de-icing quality salt in that project already. And so that delivers us 1 million tonnes a year of saleable quality de-icing salt for the US market.
Okay.
So, you know, really, really positive. And then post-tax NPV8, obviously a slightly lower discount rate for the level of study that we're at, is about $1.4 billion using the same price assumptions as we had in the scoping study. So a fairly significant step up from that 1.14 billion that we had in the scoping study. So pretty pleased with it.
Okay, taking you back to that capex figure, some of the numbers that we see across our desk for new potash projects, they're pretty big. 380 million looks, it's a lot in the current market, I suppose, but it also in relative to other potash projects looks really affordable. How is it different to what else is looking to be built in the market at the moment?
Yeah, the key differences, first and foremost, is access to mineralisation. So I've said this multiple times when I've spoken to you and on various other interviews that I do. One of the key benefits of this project is we can access our mining horizon via a decline rather than having to do a shaft. And that saves us about $1 billion compared to most Canadian potash projects. So that's the first cost saving. We don't save anything on the mine itself. The underground mine is the same. It's an underground continuous miners, room and pillar conveyor belts bringing the material up to the surface. We don't save any money on the processing. That's exactly the same as virtually every other potash project in the world. The next place that we save a lot of money is on the infrastructure. So we have put out some analysis that shows that we think we save about $500 million compared to a typical Canadian potash project on the infrastructure solution that we have available to us. The reasons for that: we're very close to our end port. We don't have to upgrade our port. We don't have to build rail lines. We're close to electricity. We're close to gas. All of those sorts of things make a big difference. And then finally, as a result of having much lower capex on those two items, we can afford to do a much smaller project. So our capital intensity is lower, but we're also, on an absolute basis, as you point out, doing a much smaller project, which in and of itself is much easier to finance given the global potash market.
Okay, and a lot of that infrastructure that you're talking about, is that what makes the cost base so low at an operating level?
Not really. The biggest driver of our competitiveness on a cost basis is our proximity to our end market. So if you look at the cost structure of the global potash market, the vast majority of potash is coming from Canada and Russia, both very remote regions from their end markets. And as a result, typically more than 50%, approaching 60% of the total delivered cost to customer is actually in transport and logistics, and in the case of Canada, in royalties. So we are significantly closer both to our end port and from our port to our target markets than either of those regions. And so we have a huge benefit from having a much lower transport and logistics costs, which really drives us into that bottom quartile.
So the de-icing salt you mentioned, that's a new part of the project. You do have a background in potash with Highfield Resources previously, but I imagine that de-icing salt is potentially new for you. How confident are you in some of the numbers that you're producing, from that that market research you've done and what you'll produce and the effect that will realistically have on the project?
So while I was at Highfield, we did a huge amount of work on the global de-icing salt market, because one of the key factors in building a mine in Spain is the inability to leave any waste on surface, and all of the waste from a potash mine is in the form of salt. So while I was working there, I did a huge amount of DD on the global salt market, and in particular on the US de-icing salt market. So I have a huge amount of, base knowledge about what is going on, how many tons are being sold. There is actually already 1 million tons a year of de-icing salt being sold from Morocco into the East Coast US de-icing salt market. So we have a fairly good idea of what cost delivered to the US would make you competitive with the global market. And the benefit we have here is, because it's a byproduct of our potash production, it's effectively free. It's a very, very small additional cost for us to take that product and granulate it and turn it into something that's saleable. And again, because of our proximity, so proximity and closeness to your customer is more and more exacerbated when the value of the commodity that you're selling goes down. De-icing salt is a relatively cheap product, so the proximity advantage that we have is really, really beneficial on that salt. And as a result, the economics look, frankly, amazing. It would be an amazing standalone project by itself. Obviously, you need the potash to have that as a byproduct. But to give you an idea, when we net off those salt byproduct credits, i.e. if we were to assume that we sell it for the average price that's been received in the last decade in the US for that salt, for 1 million tons a year, then our effective potash all-in sustaining cost delivered to Brazil would make us the lowest cost potash producer in the world. So, and I think the reason that other groups don't do this is because they can't do it, because proximity, as I made the point before, proximity with the salt is very, very important when the product value is lower, which it is for de-icing salt. So you have to be close, otherwise you won't be able to make any money on it.
Okay, and you also spoke about the scale of the project, the cost base, the infrastructure there means that you can have a smaller project. Have you looked at doing a bigger project? Have you talked to investors about whether they would support something that did have more scale?
So we have discussed it with not necessarily directly institutional investors in the traditional sense, but we've certainly discussed the ability to scale this up with potential strategic investors who are interested in, well, how big could it possibly be? The answer is, I think we're in the sweet spot for capital cost risk versus financeability versus what you get at the back end. Of course, if we were to upscale it, then the economics look even better than what we've said. So, we've got a 40% IRR, which is, in terms of my experience in mining, almost as good as I've ever seen. 40% IRR as it currently stands. If we were to do a bigger project, that would only go up. I'm actually thinking that it might be better to go the other direction and reduce that upfront capex even further. Okay. Yes, we take a little bit of a hit on our returns. However, the returns metrics will still be absolutely outstanding, and we may be able to get that financing number down closer to $200 million, which would make the story a lot easier to finance.
Wow. Okay. And scale out of the equation. At the moment, I think it's a 19-year initial mine life. With the resources that you have there and what you understand of the local geology, what are we realistically talking about when you start expanding your resource estimates and you start doing a bit of wildcat drilling?
Well, based on the resources, so the mine plan that we have is based on about 40% of the total resource inventory that we have in place today. So if you assume that we're going to get similar extraction ratios if we were to expand that mine plan and get similar extraction ratios, we would be looking at somewhere close to 45 years of mine life. So more than double more than double what we
Okay.
have today. That doesn't include any of that exploration potential that we have away to the north, to the northeast of the project, which it's never been tested. We know that there's potash there. The question is it too deep for us to mine economically? The answer is probably it will be economic, but it's something for us to do, in 2070.
Okay, fine. And you looked at the processing. You said it's very conventional processing. You were considering some other options that may have brought some of the costs down a bit. Are they completely ruled out now, or is there still some work to do on that?
From the mineral processing side?
Yeah.
So on that mineral processing side, we had an original plan in the scoping study, which was a conceptual plan based on what we had seen in the drilling data and all of the assay results. We then subsequently went and did a very detailed metallurgical test work program, which then fed back into the process design. So the process design is actually simpler than what we had in the scoping study. There's less equipment, there's less steps. We've reduced the amount of crystallization steps, so it's a much more efficient process. So actually, I think the process we've got is a significant improvement on what we had in the scoping study, and we've been pleasantly surprised that the modelling showed that actually the recoveries we're going to get from this blended ore are significantly better than if we were to just blend one of the ores by themselves. So there's been some real wins for us on the processing side as well.
Okay, and just looking at the feasibility study in its entirety, the headlining numbers, the confidence you have in the work that's been done, and the level of the study itself, how does Khemisset compare as a potash development opportunity in the global landscape at the moment, both in terms of cost and in terms of volume that you'll be producing, and then of course return on investment?
So in terms of the upfront capex, it's among the bottom one or two projects globally. So there'd be very few projects on an absolute basis that would have lower capital cost than this. Capital intensity, similar story. We are right down in the bottom decile of all global projects. In terms of scale of production, it is a relatively small project. It's not the smallest, but we're less than 1 million tonnes per annum. So we're much smaller than most of our peers. And then on the metric side, where there's almost no project that stands up to this project in terms of economic metrics. So we're, in terms of post-tax NPV8, $1.4 billion, using those base case price assumptions, you wouldn't find another project getting close to that. And that's really driven by the fact that our costs are competitive. So we're bottom quartile operating costs, but our upfront capex and capital intensity is just so much lower than everybody else's. In terms of the confidence on the project, the engineers that we appointed, Golder and Barr Associates out of the US, to manage this process are incredibly experienced engineers. I would say we have done far more work than what I would typically see in a feasibility study that's going to be used for financing discussions, so a bankable feasibility study. In terms of the engineering level, a much higher engineering level than I would have been used to in the various other jobs that I've had. So we're very, very comfortable with the amount of work that's been done, and we're very confident that the numbers that have been presented will pass muster when we get to that process.
Hayden, looks like fantastic news. Congratulations, and thanks for joining us.